Okay, so we're right back at it again, and this is going to be a little addendum to the Bridge Loans 1.0. In the first example, we talked about being able to get a home equity line of credit. But there's some things that you couldn't do that would disqualify you for getting one. So if that doesn't work, what are your options? Well, we're going to be talking about alternative funding sources for bridge loans today in thecreditjungle.com. My name is George Anderson, and thank you for joining. So I've left the same example on the board here, but I've just entitled this one Funding Sources and Bridge Loans 2.0. So a home equity line of credit is probably the easiest way to do it, but what will happen sometimes is, what if your home has already been listed? Well, if it's already listed, guess what? The institutional lender that you're going to go to is going to see that, oh, well, you're already intending to sell this home, so we don't really want to do a loan on this one. We'd be happy to do one on this one after you buy it, but they're not going to give you what we call concurrent subordinate financing. That's a long, kind of a technical term for saying they're not going to give you a second mortgage in advance on this house. They want you to buy it first. Well, that doesn't work until you buy it. So if you can't get a home equity line of credit and you can't use the proposed equity or that you intend to have on the next house, I mean, where are you going to get your cash? So one of the real common sources for doing this is a lot of people would have this $50,000 down payment. They would have it in a 401k plan. And if you borrow money from your 401k, now a lot of people don't like to do that because you have a pretty stiff payment, your money's out of the market, and you're going to have some repayment terms that are going to come in there, and you're going to hit your paycheck, pretty steeply. And there's an interest rate that you're paying on it. However, you are paying that interest back to yourself. So whether it's 2% or 12%, it really doesn't matter because you're just paying that interest back to yourself. And the good news is regardless if you're doing an FHA loan or a conventional loan, if you're doing VA, you don't have to worry about the down payment. But if you're doing an FHA or conventional loan, if that payment is secured or collateralized against your 401k, well, you're paying back yourself. So whether that payment is $200 a month or $1,000 a month, it does not factor into your debt ratios. So if you remember back here using this example, we had to count the payment on this $250,000 loan plus your home equity line of credit payment plus the new payment on the $450 over here. Well, if your debt ratios are too tight to be able to make all three of these in here work, well, borrowing from your 401k is a better option because I don't have to count your payment. If you wanted to borrow $50,000, $65,000, whatever that is, that payment does not count your debt ratios. So a 401k loan can be a good option. Well, some people, and this again, there's not any rules like federal regulations on this. Each plan administrator has their own guidelines or their own policies. Some of them will not allow you to take out a 401k loan, but you can take out a withdrawal. Now, this gets kind of tricky here, and I'm not a tax advisor, so I'm giving just some general information. But typically, you can take money and withdraw it from an IRA plan or a 401k plan, and if you replace it, if you put it back in, if you pay the money back and you do it within 60 days, then you don't have to pay the penalties. It's not considered a taxable event. So that's another option you could do. If you had the money in there, you could go ahead and take a withdrawal. A lot of times they're not going to let you withdraw the full amount. They're going to withhold, typically 10% for penalty and about another 20% for taxes. So if you had, 80,000 in there, okay, you're only going to get about 56,000 or about 70% of that. So factor all that in. The thing you have to understand is that once you've done that, you're running the clock now. So you want to make sure that you found this home, you have a contract here, make sure that you're pricing your home well, you're working with a good real estate agent that understands the market, how to price your home so that it sells, because if that money you withdraw from your IRA 401k over here and use for your down payment, which is a perfectly legitimate source of funds for your down payment, you've got to have this home sold here quick so you can net out your proceeds from the sale of this home and replenish back your IRA and 401k. So that's one way to be able to do it if the home equity line of credit option doesn't work for you. The other thing is some just family money. I mean, that can be a loan, it can be a gift, however you want to structure that. And then in some cases, myself included, there are some private lenders that will come in there and they'll just say, yeah, you're a really good solid borrower. I can see that, you're going to have some plenty of equity here to be able to do this. A private lender might not go to 90% combined loan to value here, might shave it down to 85%. But anyway, you're going to be able to tap your equity in a variety of different ways that are all acceptable sources of a down payment to meet the underwriting guidelines to get into this home. Now, if all of those flat fall on their face over there, there's a couple of other options that we'll get into, and we're going to talk about how to structure combination first and second mortgages and some ways to be able to get a little bit more creative over here with the financing on this side of it. But there's more than one way to skin a cat, and so if you know that you've got fairly decent credit, if you've got fairly decent equity in this home, and if you have some alternative sources through a retirement plan, cash, family member, or that you can qualify for that home equity line of credit, there's no reason to not go start looking, or at least to not let an opportunity go by. If that dream home that you would really, really love to get into, if that comes available, well then by all means you want to be able to jump on it. And right now, just to supplement this a little bit with the current market conditions, the interest rate that you have on this loan could very well be a lower interest rate than you have on this one. And anytime that you have decreasing interest rates like we have now in the current market, the trade-up play, your mortgage payment, even though you're financing an extra $100,000, you run the numbers on this and your payment, or actually another $200,000, your payment may go up a lot less than you think. It might only be going up in much smaller multiples, maybe $500-600 a month more to get into a home that is substantially more to meet your needs if you have a growing family or you have elderly family members that need kind of their own little space or whatever the circumstances might be. So anyway, there's always more than one way to skin a cat, and just to be able to realize that you can continue to go and look for opportunities to get into those nicer homes. If you have equity in your home, there's a way to make it work. So thanks for coming into thecreditjungle.com today. My name is George Anderson, and I hope to talk to you soon. You can push button, get mortgage professional, and I'm right here waiting to answer your questions. Have a great day.